And so you, again, like even just from a macro perspective, and a lot of people, if you guys follow like Lynn Alden, she's been saying that a lot as well, right? Like that you don't have to really pay too much attention to what the Fed is doing. It's more about what's going on with a fiscal policy, because that's the main thing driving global liquidity now. So you can make the case that you shouldn't even be watching the Fed at all, which I don't think is the case. I think you do need to watch the Fed a little bit at least, because the markets do respond to that, at least in the short term. Again, you can see that so if this is the thing that was kind of quote unquote different between prior cycles, the Fed cuts and QE, then the thing that is the same is the rise in global liquidity. And that begs the question, it's like, okay, well, how can I track a global liquidity, especially because there's all these different measures out there. You have measure of cross-border capital, you have measures from Real Vision, you have measures from, all these different sites and sources. And the question is, okay, but how can I get a sense of where global liquidity is going to go? And in my opinion, in my view, the answer is just to look at the DXY, the US dollar index. Why is that? Because basically a lot of, I guess, liquidity is kind of like tied up in debts and like in terms of debt refinancing, at least according to Michael Howell, a lot of the liquidity cycle and everything follows the debt refinancing cycle. So basically when it comes to the DXY, when the US dollar gets weaker, this makes it easier for all these companies and countries around the world and individuals, whatever, that have tens of trillions of US dollar debts. It makes it easier for them to pay back those debts because those debts become cheaper. And if their debts become cheaper, then the result is that they have extra money to spend on investing in assets and spending into the economy and whatever, right? So that's why the DXY is so important. When you see a drop in the DXY, that typically corresponds to a surge in global liquidity. And as I mentioned in recent videos, what I believe we're seeing right now is a second leg lower in the DXY, exactly the same like we saw at the end of 2017. There was a second leg lower in the DXY, corresponded to a huge altcoin rally, exactly like we saw at the end of 2020. Second leg lower in the DXY corresponded to a huge altcoin rally, and we are in the process of now seeing a second leg lower in the DXY in 2025, and I do believe that's going to correspond to an altcoin rally. Precisely when is that going to happen? I personally believe it's going to happen in Q3. And again, I do think that the psychological aspect of a lot of people expecting a Q4 cycle top is going to be the catalyst for that. Basically, like if we do get a rally over the summer, which I think that we will, I'm looking more at like ranges here. And I do think that we're at the upper level of the range. I do think Ben is right that Bitcoin dominance probably tops somewhere here around 66%. Again, could it go a little bit higher? Sure. But if it goes up to like 67, whatever, is it really that big of a difference if it's like an extra week or two? I don't really think so. So we're basically at the top here of Bitcoin dominance, and I do think that it'll fall probably not all the way down to 40%, which sounds like that's what everyone is watching. It'll probably go more to something like just under 50, and I do think that'll be sufficient for a massive altcoin season, especially when you consider that like Bitcoin's valuation is likely to be very, very big in this cycle.